Hello traders, welcome back to the Com Lucro channel. In today's video, we're diving into a crucial chapter of our Wyckoff Method course, Advanced Supply and Demand Analysis. This chapter is vital for any trader aiming to understand the underlying forces that drive price movements and make well-informed trading decisions. We'll break down the fundamentals of supply and demand, showing how volume signals reflect the strength of these forces, and cover Wyckoff's key laws and patterns to help you detect shifts in trend momentum. This understanding will enable you to interpret market behavior more accurately, align with the intentions of large players, and refine your entry and exit strategies. Throughout the lesson, we'll walk you through the stages, from recognizing demand and supply indicators to applying Wyckoff's phases in trading ranges. By the end, you'll be able to spot these dynamics in real market conditions, pinpointing ideal entry and exit points that align with market trends. Remember, this video is part of our complete Wyckoff Method course, so be sure to check out our other videos and visit our website for further insights. After this brief message, we'll dive in and unlock the power of Wyckoff's advanced supply and demand analysis to transform your trading approach. Stay tuned, you won't want to miss it. Hey traders, if you're looking to level up your trading game, give this video a thumbs up, subscribe to the channel, and hit that notification bell so you never miss an update. Before we dive in, we highly recommend checking out our playlists on trading psychology and risk management. These videos can significantly help you manage emotions, maintain discipline, and develop effective risk management strategies. Key elements for achieving profitability in trading. Please listen, and remember, no amount of study to find the perfect trading strategy will benefit you if you lack emotional control during your trades. If you cannot accept a losing trade and keep moving your stop loss, or worse, trade without a stop loss, you are setting yourself up for failure. The efficiency of your strategy is directly tied to your risk management and emotional discipline. Only when a trader understands and implements this can they start seeing consistent profits and end their months in the green. Without these critical elements, even the best strategies will crumble under poor execution and emotional decision-making. Now let's get started. First, let's get to the heart of this chapter, mastering advanced supply and demand analysis and its role in effective trading. Understanding these dynamics reveals how shifts in buying and selling power impact price, equipping you with the tools to make strategic decisions. We'll start with the fundamentals of supply and demand and the importance of volume in confirming these movements. Next, we'll explore Wyckoff's key laws, such as effort versus result, and discuss phases within trading ranges. Finally, we'll highlight how recognizing these patterns and avoiding common mistakes can help you capture trading opportunities aligned with major players. While this video lays the groundwork, upcoming chapters will cover advanced techniques for applying Wyckoff's principles in real time. By the end of this lesson, you'll be ready to integrate this analysis into your trading strategy. We'll be using TradingView as our analysis tool, as it's one of the most popular platforms among professional and retail traders alike, offering both accessibility and a high degree of customization. With TradingView's flexibility, your screen setup might differ from what you see here, but the principles we're applying remain the same. Other platforms may offer similar features, but keep in mind that data presentation and some indicators can vary slightly between platforms. It's essential to become proficient with the specific tool you choose to operate with. Mastering your platform is fundamental. It's a basic yet crucial step in becoming a successful trader. Now, let's dive into the core principles of Wyckoff's supply and demand analysis. Understanding these principles is essential for interpreting market dynamics effectively. First, supply and demand represent the core drivers of price direction. In simple terms, supply is the willingness of sellers to sell, while demand is the interest of buyers to purchase. When demand exceeds supply, prices rise, and when supply overtakes demand, prices decline. This balance or imbalance defines market direction, guiding traders to spot potential price reversals and continuation patterns. This foundation helps traders develop sharper insights into shifts in market behavior and potential trading opportunities. Equally crucial is volume, which reveals the strength behind price movements. Volume analysis shows whether a price change has substantial backing or if a reversal is more likely. High volume on an uptrend signals strong demand, while high volume during a downtrend often signals a dominant supply. Low volume, however, could indicate a lack of commitment from participants, suggesting a potential pause or reversal. By examining volume and price together, traders gain insights into the intentions of market players, leading to better informed decisions. For more on these core principles, check out our videos, Master Supply and Demand Zones, Boost Your Trading Strategy, and Supply and Demand Trading Strategies to Maximize Your Profits. These videos explore strategies specifically for identifying and utilizing supply and demand zones in real-world trading. Now, let's explore Wyckoff's fundamental laws applied in advanced analysis. Here, we apply two of Wyckoff's cornerstone principles, the law of supply and demand and the law of effort versus result, each providing vital insights for identifying entry and exit points. The law of supply and demand underscores the balance between buying and selling as the primary driver of price trends. In an uptrend, buying pressure must consistently outpace selling, driving prices up until a new equilibrium is reached. Similarly, when supply exceeds demand, prices decline until either selling interest wanes or demand re-emerges. This law enables traders to gauge trend momentum and prepare for reversals based on observable shifts in buying and selling activity. Effort versus result, meanwhile, examines how volume, effort, correlates with price movement, result. When both align, for example, a strong price rise with high volume, it suggests that the trend has strong support and is likely to continue. However, if volume spikes without a corresponding price increase, this often signals resistance, where significant selling occurs, absorbing the demand. Recognizing these moments helps traders identify points of potential trend reversal as large players shift positions, often stalling upward movement. Together, these laws enhance a trader's ability to interpret subtle changes in trend momentum, pinpointing price inflection points and helping align trades with the market's underlying supply and demand dynamics. Next, let's proceed to reading volume and price patterns, where we explore how volume and price interactions reveal the intentions of market participants. Starting with demand indicators, when a price bar shows a wide spread, closes well above prior levels, and is paired with above-average volume, it often signifies active demand. This shows that buyers are motivated, pushing the price up as they compete for available shares, and this buying pressure typically signals potential for further upward movement. On the other hand, supply indicators include price bars closing significantly lower than previous lows on high volume. This pattern indicates selling pressure as sellers offload positions, even at falling prices, often outpacing buying interest. Recognizing these supply-driven signals alerts traders to potential downtrends or short-term pullbacks, especially when supply continues to dominate. An essential skill in Wyckoff's analysis is recognizing subtle nuances within volume and price patterns. For instance, a volume spike without significant price movement often indicates absorption, where large players are quietly accumulating without pushing prices up. These absorption patterns often precede major breakouts, providing valuable signals for proactive trading. Now, let's discuss the application of Wyckoff's phases and events in trading ranges, which offers critical insights for identifying turning points within market trading ranges. Wyckoff's method divides trading ranges into phases that reveal the market intentions of large players. Key phases include accumulation and distribution. During accumulation, major players buy shares without causing substantial price increases, building positions quietly. This phase often shows repeated tests of lower support levels on diminishing volume, signaling that sellers are gradually exiting while demand builds. Conversely, during distribution, large players start to offload their holdings. Prices fluctuate within a range, and frequent high-volume resistance tests suggest significant selling. Recognizing these signs helps traders anticipate downtrends as selling pressure exceeds demand. Wyckoff also identified events within these phases, such as the spring in accumulation and upthrust in distribution. A spring is a temporary dip below support, often intended to trigger stop-loss orders and allow major players to accumulate more shares at lower prices. An upthrust, conversely, is a breakout above resistance in a distribution phase, which can create a false bullish impression before prices decline. By identifying these events, traders can strategically align their actions with those of major players who shape these patterns. Now, let's move to combined analysis of supply and demand with effort versus result. Here, we integrate Wyckoff's first and third laws to enrich our interpretation of market dynamics, helping traders anticipate trend shifts. The law of supply and demand teaches that price changes result from imbalances between buying and selling forces. For example, when demand starts to weaken after a prolonged uptrend, it may indicate that the price is approaching equilibrium, where selling pressure could soon dominate. Recognizing this shift allows traders to lock in gains before a reversal. The law of effort versus result further clarifies trend strength. When effort, volume, and result, price movement, are aligned, the trend is likely to continue. However, if volume spikes without a corresponding price movement, it suggests potential resistance. This scenario hints that large players are selling into the demand, forming a resistance level that could reverse the trend. This combined approach helps traders interpret key points of price equilibrium and potential imbalances more accurately. For instance, a volume spike during a downtrend without further price drop may indicate absorption, suggesting accumulation by large players. Recognizing such nuances enables traders to better prepare for potential trend changes, aligning their trades with the market's natural rhythm. To illustrate these concepts, let's examine a case study. This example shows how effort versus result unfolds in real market conditions across 3 distinct price reactions. In reaction 1, we see a sharp decline paired with increasing volume, indicating alignment between effort and result. The strong selling pressure suggests that further decline is likely unless there's a shift in demand. For reaction 2, a second decline appears but with noticeably lower volume and reduced price drop. This indicates that supply is beginning to taper off, suggesting that the selling pressure may be exhausting and allowing for a potential short-term recovery as buyers step in. Finally, in reaction 3, volume increases without a proportional price rise. This indicates that large players are absorbing the demand, accumulating shares in anticipation of a rally. This accumulation signals a possible upcoming breakout, as buyers are positioning ahead of a price increase. By analyzing these reactions, traders gain insights into the behavior of influential market players, empowering them to adjust their strategies accordingly and anticipate price movements with greater precision. To wrap up, let's focus on practical insights and application. Mastering Wyckoff's supply and demand analysis calls for both technical skill and a sharp, curious mindset. By applying these principles in real time, traders can effectively spot market cues and predict turning points with greater accuracy. A crucial strategy is to analyze volume and price together to gauge a trend's sustainability. For instance, high volume without substantial price movement may signal absorption or distribution by major players, hinting at potential reversals. Additionally, recognizing Wyckoff's phases and trading ranges allows traders to better time their entries and exits. Wyckoff's method goes beyond technical skills. It taps into the psychology of market movements. With consistent practice and refinement, traders can align their strategies with the market's flow, developing a deeper understanding of these dynamics. In conclusion, mastering advanced supply and demand analysis with the Wyckoff method provides a powerful edge in understanding the market. By recognizing key phases, events, and volume patterns, you can better interpret the actions of large players and make informed trading decisions. Remember, this video is part of our comprehensive Wyckoff Method course. Check out our other videos and website resources to continue expanding your expertise. We're here to support you on your trading journey and look forward to seeing you in the next video. I hope you enjoyed today's video. If you found the content useful or fun, please give it a like, as this helps the video reach more traders like you. Remember to subscribe to the channel and activate notifications to stay updated with the latest financial market information and trading tips. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Your support allows us to continue bringing high-quality content, helping you make more informed decisions in the markets. Thank you for watching and good luck on achieving excellent results in your trades.